Consumer inflation increased at a faster pace in December, more than market expectations. Statistics South Africa says the annual consumer price inflation was 5.9% in December. That's up from 5.5% in November. This is the highest annual increase since March of 2017, when the rate was 6.1%. On a month-on-month basis, the consumer price index increased by 0.6% in December. The main contributors to the 5.9% annual inflation rate were food and non-alcoholic beverages, housing and utilities and transport. The petrol price went up by 75 cents per litre in December, pushing a litre of petrol in Gauteng to 20 Rand 29 cents. The 5.9% December inflation rate puts the average annual inflation for 2021 at 4.5%. That's in line with the Reserve Bank's expectations. The central bank expects inflation for this year to average 4.3%. At its last meeting, the Reserve Bank said its quarterly projection model indicates further rate increases of 25 basis points in each of the quarters of this year. Well, to get more on this, I'm joined by the Executive Chief Economist at Alexander Forbes, Isaah Mhlanga. Thanks very much, Isaah, for joining us. So what is your feeling about this latest print, 5.9%? Should we be concerned?
Indeed, we should be concerned. If we look in terms of the drivers of that inflation, the extreme supply side and supply side factors are still going to be with us, like in the global environment. The delay of goods production, but also shipping is playing a part, which means we are also going to feel the pressure. If you just look in terms of goods inflation, it accelerated to 8.5% year on year from 7.9% previously. But if you look in terms of services inflation, it's still at 3.3% from 3.1%. So it's very clear that this is a supply side driven inflation that we are seeing. But also if you're just looking from a contribution point of view, petrol prices have contributed significantly to that transport inflation, which contributed 2.3 percentage points out of the 5.9%, which means we are likely to see this upward pressure. Oil prices remain quite elevated. We have the US Fed that is expected to hike rates 4 times this year, which means major market currencies, including the South African rand, are likely going to weaken. Combined with the high oil prices, we are going to see elevated fuel price that contribute to that headline inflation. But if you look at core, which is the part that is in line with underlying consumer demand, it's at 3.4%, closer to the lower target of the Reserve Bank. So there is no demand pull inflation.
Isaah, how concerned are you about Eskom wanting a 20.5% increase, which would come into effect in April and July? How much of a game changer would that be for the inflation rate?
Look, it's an upside risk. If they get it, it means we are going to see headline inflation likely piercing through the 6% upper target range for the SAB, which will then prompt the SAB to aggressively hike interest rate relative to what is expected currently. Their own models say 4 times this year of 25 basis points each, which means 1 each quarter. If we see both the oil price but also Eskom being granted that 20%, it means we are going to have a risk of even further hikes this year, which means higher debt costs for those that have home loans, vehicle installments, but also credit cards. That is going to increase in terms of the repayment, because usually they are linked to the repo rate.
Yeah. Now, we're looking at the consumer price inflation index, which basically is a 1-month lag. So we're looking at the December number, but the retail sales numbers have also come out, but that's for the month of November, which is a 2-month lag. But that shows that consumers are actually not doing too badly at the shops. That was up by 3.3% on an annual basis compared to 1.9% in October. Was that because people were taking advantage of Black Friday? Because it suggests that the consumer still has some rands and cents to go to the shops.
Indeed, when COVID hit, we saw a marginal accumulation of forced savings that was spent throughout March of 2021. but those savings are now sitting at 1.2% of disposable income, which is not a lot. But if you look in terms of the unemployment rate, it's at 34.9%, and we also have another factor in the case of minimum wages that are out that have been gazetted for increase, which means from a labor market point of view, we are unlikely to see a recovery that is going to lead to a demand pull inflation going forward. Yes, retail sales has been positive and strong up to November. Festive season spending is expected, but it's no way near to what we had seen before the pandemic as far as Black Friday is concerned. The forward-looking factors just say we are unlikely to see a robust economic performance that is going to lead to job creation and robust growth in salaries and wages that are going to lead to demand pull inflation. What is very clear from the goods inflation relative to service inflation, from supply side factors including oil prices and the potential weakening in the currency, inflation will remain elevated at least in the first half of this year.
All right, Isaah, we're going to leave it there, but thank you very much for your insights as always. Isaah Mhlanga, he's the Executive Chief Economist at Alexander Forbes.